So on December 2nd, Congress dragged the financial regulators to Capitol Hill for some testimony. And so I thought this would be a good time to discuss how the pendulum in banking regulation has really swung back in favor to the banks, and like swung back in a big way. And this is really led by Miki Bowman in particular. She's been dropping some serious nukes in the supervision world.
Miki.
You've been on a couple of calls with her, right? Didn't she used to call into some like marketing briefs?
Yeah, she would listen in. Actually, right. And yeah, she would actually ask some questions sometimes. Usually it was like the higher up you are, the less questions you have to ask, because you just ask your people afterwards and then they go scatter and, But yeah, no, she was on there. She was a little more personable. Like I think we didn't even know. Like we heard like Powell and like Yellen even before, dialed in before, but they didn't announce themselves. They obviously didn't say a word. They were just in the shadows. But Miki, every morning she was at roll call. She checked in. That's why I know. Not to
a one-on-one, right? The one-on-one call.
Exactly. Yeah, that's right. That's right. More like 80 on
80 people,
5
right?
or something like that.
Yeah. Anyway, so there are boatloads of stuff to cover here. And an attempt, I was trying to think of like how to frame this. Like, I'm not just going to start listing off bullet points. I thought that was kind of lame. And sort of in research for this, I kind of uncovered a speech given by Governor Michael Barr. And he gave this on November 18th called, quote unquote, the case for strong, effective banking supervision. And the speech really touches upon the big changes proposed by the three horsemen and the horsewoman, I guess, of the supervisory apocalypse, and sort of by extension Trump. And what Michael Barr was saying, he was arguing against all these changes. So I thought this would be a good way to use that as a framework, hit upon his points. But it also gives me the chance to show where I think Governor Barr is being a little bit sneaky, I think, in his arguments. So like there are a few whiffs of BS in there, I think. And, my goal isn't to like dunk on it, but you have to also recognize, you have to recognize that he's arguing a case. He's making a thesis. Right. And whenever someone does that, they sort of take some liberties, I think, in logic or wording or like characterization or evidence even that I'm going to try to expose.
Because you start with your conclusion and you get to where you want to go rather than, let me figure out where I want to go.
The other thing is, though, it's a pretty long speech and I can't respond to each part. But real quickly, just to start, before we get really even into his main points, he already kind of annoyed me. Like, because he spent a good chunk at the beginning talking about how important effective supervision is. Now you would think, oh, why is that? Yeah, that makes sense. The reason why, and just he kind of kept going on about it, I think doing that sets up a dichotomy in the audience's mind as though, regulation versus no regulation. And he's making the clear case that he's on the quote unquote regulation side. Like, we need good regulation. We need effective regulation. But that almost implies as though like Miki and the team is on the other side, as though they're arguing for no regulation, which is just not the case. Like, no one's arguing for no regulation. He's like subtly standing up, I think, a phantom enemy. It's not even a straw man. He doesn't articulate any of the points. He just is sort of saying like
two choice fallacy or whatever it's called.
Supervision is good. We need strong supervision. He's got the audience nodding along, agreeing with him. Okay, you can't disagree. You want good supervision. Anyway, it kind of already annoyed me. But then he sort of gets into the meat of his argument. And the speech touches upon really 3 points to what effective supervision needs. The first is credible ratings framework. So what is that? That's basically what's on the scorecard. So today, most banks are rated with a CAMELS rating system, which stands for capital adequacy, asset quality, management, earnings, liquidity, and sensitivity to market risk. The second supervisory component he talked about is what he called forward-looking supervision, which is this new concept that was introduced after the 2008 financial crisis. What it essentially just means are stress tests, which actually I'm not going to try to cover that. And then lastly, the third thing he was talking about is a strong supervisory staff. So this is the regulators themselves. Now, Bowman, we're going to find out, I think, has got some plans for her staff. There might be a lot fewer of them. Don't look so upset, okay? So, I know Marcus never liked supervision and all that. But hey, quick interruption. It's Luke in the editing room. Joe and I get after each other a bit more than usual in this episode, and we need to give you some background to follow it. So we both worked at the Fed. I worked at supervision, being a regulator, and he worked in markets, managing monetary policy. The markets and supervision groups don't really interact at all, and there's kind of some natural competition between the two. So that's where a lot of this and future jabs really are coming from. So just wanted to give you that background. Enjoy. Back at the Fed, but please fake it. On to the credible ratings framework. His first subpoint is in response to a press release. Now, this was November 5th. And just for a little bit of background, he's responding specifically to the LFI rating system. Now, that's different from CAMELS. But in the LFI, there are three main areas assessed. That's capital planning and positions, liquidity risk management and positions, and governance and controls. And then each one of those three can get a grade, and there are 4 grades. Broadly meets expectations, or BME, conditionally meet expectations, CME, deficient 1, and deficient 2. Okay. Now here's the kicker. This is the important part. Before the policy change, if a firm is rated D1 or below on any one of those 3 areas, then they are considered not well managed. So even if you have great capital, great liquidity, if your governance and controls are D1 or below, they cannot be considered quote unquote well managed. Now, if you are not considered well managed, then there are certain actions that the bank is not allowed to do, like acquire other banks. Okay. So now one of the main policy changes is that, okay, well, now you need at least 2 of these D1s. Okay. So you can have a D1 and still be considered well managed. So guess what? So Governor Barr comes around and he calls it grade inflation. Can you believe that?
For example, earlier this month, the Federal Reserve Board issued a final rule making changes to the large financial institution rating system. Poor performance is being de-emphasized, which is tantamount to grade inflation, a problem this academic audience likely understands. As I noted in dissent at the time, I believe these changes reduce incentives for large banks to fix serious management problems. They will also allow firms with significant governance weaknesses to expand or acquire other enterprises, raising the chance and cost of future failure.
First of all, it seems like there was some shots fired there. He said, sounds like he was in an academic setting. Grade inflation's I've seen it come up more and more in the news right now. Everyone needs, everyone's getting A's all the time.
He was talking about, so the audience was American University, I think. That's where he gave the speech. And yeah, he definitely had a shot at a joke. That's where I cringed a little bit. I thought it was a joke. I thought he was trying to make it funny. I don't think it didn't land. And for a theme throughout this entire thing with the pendulum swinging over in this deregulation thing is to de-emphasize how much these governance and controls can impact you. That's really what it is. It's a very strong focus back to just like fundamental financials and how that use that to assess a bank, and not stuff like this next thing, which we're going to talk about. So let's go to the next one. The next one, the administration is going to get rid of the M in CAMELS. So the M is management. And I think M has been around since the beginning of CAMELS. So this is the mid-90s.
I understand that efforts are currently underway to modify the CAMELS rating system, the interagency framework used by supervisors to assess banks' overall condition. Some have proposed changes that would effectively diminish the weight assigned to the management component. I believe that such a move would be misguided and cited. The management rating is not simply one item among 6. It is the element that ties the others together. It measures the quality of governance, risk identification, internal controls, and the institution's ability to respond to emerging threats.
Makes sense, but like it also seems like if you just evaluate the other things, you could almost say like it's a good management to achieve good outcomes is kind of a implicit.
Right. So let me give you my take. So first off, the footnotes in his speech don't have a link to the source of this. And even in the language when he said there's some talks about doing this, hinted as much. But I think I know what he's referring to specifically. And you need to look at that absolute bomb of an internal memo from Miki Memo, which was released just a few weeks ago. So I think on the date of it is 10/31, but they released it several weeks after that in like a press release. Let me, just to kind of convince you of that, let me highlight a few quotes from this one. Okay. Let me just set the tone here with what's in that memo. All right. Quote, as a guiding principle, staff should not assume that our current or past operating practices should continue going forward.
Pretty strong.
It's very strong. So regulators should not become distracted from this priority by devoting excess attention to processes, procedures, and documentation that do not pose a material risk to a firm's safety and soundness. So again, de-emphasizing this whole idea of, policies, procedures, documentation, and stuff like that. Here's another one. Examiners and other supervisory staff can address shortcomings that do not rise to the level of MRAs or MRIAs by making non-binding supervisory observations. And she says, we will be amending SR 1313 to revise its directive to eliminate supervisory observations. So she's just flat out basically saying fewer MRAs, more observations, go easier on the banks.
Lighter touch.
Right. So now here's the quote that what he's sort of referring to. She wrote, same memo, supervisory ratings should accurately reflect an institution's financial condition and material financial risks. The management and risk management component of CAMELS and RFI/C, that's another ratings methodology, should not be given more weight than the other components in determining a firm's composite rating. So you remember when he said that, quote, management was rating that ties the others together? So now in my take, management is just a bunch of double counting. So the thing is, the other categories, the CAELS, those are each assessed in two halves. One is the actual risk metric. So like liquidity, you can look at the liquidity metrics. What is the numerical liquidity level, whatever. And then second is the liquidity risk management. And then management is sort of collectively double counting all those risk management halves. And he basically says as much. So if I were to have like a nice dinner with Governor Barr, I would challenge him to come up basically with this question. Just come up with a time in which the composite rating was buoyed by management, not hindered by it. And I think he would have a hard time coming up with an example, because it's really just like double counting the negatives. It's sort of reflecting the other ones. That would be sort of what I would add to that.
It's a pretty strong call out there, Luke. Whenever Barr watches this, he's gonna have to
leave a comment, Barr.
Find some examples.
Maybe I'm wrong. That was a challenge. I could be wrong, but the idea that they kind of tied together, it's sort of a nice way of saying that they double count stuff, I think. All right, next one. So next he talked about this new definition for quote unquote unsafe and unsound practices, which came out. Okay. Now I can tell you, this is huge. This is a big deal because no one before that really knew exactly what unsafe and unsound meant and the corollary, what safe and sound meant. So they define it. Are you ready? You got a pen and paper?
Bring it on.
All right. It means a practice, act, or failure will act alone or together with other practices, acts, or failures to act that is contrary to generally accepted standards of prudent operation. It has materially harmed the financial condition of the institution, or if continued, is likely to materially harm the financial condition of the institution or present a material risk of loss to the deposit insurance fund. What do you think? Isn't that great?
That is the ultimate central bank hedged statement. That was written by 400 people.
No. It's brilliant. It's brilliant. This is a Christmas gift. I am not being sarcastic, by the way. As much as you might think I am, this is huge. I know it just sounds like a bunch of gobbledygook, but let me break it down.
Well, not gobbledygook.
It's not gobbledygook. It all makes sense.
I think it makes sense. It's just so broad in general that's like you can't argue against it. That's what I mean when I say 400 people wrote it.
I know. So like people would read that and be like, "Oh, you mean it's how could it be anything else?" It's like obviously, right? Right? All right, let me break it down for you. Let me show you like why this is a big deal. So there's a few things in there. One is the emphasis again on the financial condition. So again, they're referring back to this financial condition again. It's not just the processes and documentation. That's one. The emphasis on financial condition. That's not obvious. Two is the use of the word likely as opposed to possible. So like something has to likely cause harm. It doesn't have to just possibly cause harm. That's a standard that's being set here. Three is this concept of quote unquote prudent operation. This is important. This acknowledges that it's a bank's job to take and manage risk. So just because something is risky does not necessarily mean it isn't prudent. And then the last one, this is a little bit more esoteric. The last one is the reference to the loss to the diff, which in my read, it should cover stress testing. So again, so this definition is, I think, part of a broader theme in this pendulum swing to write down definitions. The other main example is the clarifying stuff in the Genius Act, having to do around crypto and like stable coins and stuff. What is and is not allowed. And these definitions, I think, protect against banks operating with a feeling of like a sword or a hammer that's just hanging over their heads because they don't know exactly like what is and is not allowed. So in general, I'm like supportive of you being a little bit more clear about this. But let's see what he says.
Standards for issuing enforcement actions in MRA center on a narrow definition of material financial risk and exclude material non-financial risks except in limited circumstances, such as violations of law. To put this into context, under the standard established by this proposed rule, a bank with woefully deficient controls to prevent money laundering or discrimination would not necessarily receive an MRA requiring the bank to correct the situation unless the bank had actually violated the law, where supervisors were able to identify a material financial harm that had already occurred due to the lapse in controls, or that could be shown to be likely to cause such harm.
The case that he's making is that it's going to be more difficult for, say, regulators that have come across what he calls hopefully deficient controls to do anything about it, right? Because the regulators can't draw a direct line between the practice and then a material financial harm, then they can't give an MRA. What do you think about that?
Like you started all this, his phrasing is very difficult to disagree with fundamentally. It makes sense. Like you shouldn't wait until after something has already broken the law to, take action against this, but focus proactively on the controls themselves before something happens.
The first thing he said is that a bank would need to violate the law before getting an MRA. Right, but that's not quite true. It's the law or the regulation. I don't know why he left that out. So regulators can still issue MRAs or other enforcement action if the bank broke the law or regulation. Now, the unsafe and unsound part is there to potentially catch other things that are not explicitly covered by the regulation, right? So there's a little bit of discretion there. Now, I think the problem and the reason why this has been enacted is that banks are upset, and I think justifiably so, that they are getting written up with enforcement actions even though they haven't broken a law or regulation. So now they're sticking a definition to it. Now you combine that with the new part is that they are going to allow observations. So if you haven't broken a law or regulation, can still write you up on something, but it's not binding. It's an observation. It's like, look, maybe you should think about doing this.
Yeah, if you break the law, that one's pretty obvious.
I thought it was curious that he mentioned, I think he was talking about BSA AML, which is, in my view, like notoriously prescriptive. It tells you like exactly in the KYC, the know your customer part, it tells you exactly what kind of information you need to get from the customer. It's like you have to get name, you got to get their address, you got to get and it's just listed out in the regulation. And there's like nothing clearer that if you go to a bank and you like look at, show me the form, the KYC form that you're giving to your clients to fill out, and you just put them side by side and you're like, hey, you're missing XYZ, bam, that's an MRA. There's one other kind of thing going on here. It has to do with incentives. So what do you think the incentives are for a regulator?
Make things more complicated, get a bigger budget, hire more people.
Joe, you're talking about
more power.
Whoa, Joe. Hey, whoa, take it easy. And what's market people just? They just want to print money. So we just want to buy up stuff, don't you? You just want to give money away.
Well, no, I mean, they got the same idea. We need more people. We got to hire more people. We got to do more things. We got to grow.
What I'm talking about is like at the actual regulator level, like the individual.
Make the financial system safer.
They're just trying to do a good job, right, Joe? I mean, they show up every day and they're trying to do a good job. And the thing is, when you're a regulator, you don't really feel like you're doing a good job unless you find issues. You got to realize that. Like, I've been there. Okay, I want to do a good job, and if you find issues, then you're bringing them up to the examiner in charge. You're kind of doing a good job. But if you're a regulator and you go through like 10 exams, 20 exams, and you don't find anything ever, people start to wonder, like, okay, is this guy doing anything? You know what I mean? So, like,
yeah, I mean, conceptually, like, it definitely makes sense. But I mean, I don't know. Not if you're doing all the evaluations very methodically and it's documented very well, then that is doing a really good job. And, and there's no problems and all that stuff. Look at my 8,000 pages of reporting that I wrote, and this bank hasn't had a single issue because I'm there making sure the guardrails are being enforced correctly. Right?
Is that how we do it? I want to know what you're doing over there in markets. Just like filling orders. Oh, hey, you want some money?
That's not far off. That's pretty much it.
I mean, they even like tell you. I'm just thinking, if you're on like one of the repo lines, you already know the price.
Yeah, exactly. You want some? Call up. Yeah, you want something?
You want some?
Yep.
Yeah, hey, let's do it.
Yep. Sec lending and treasuries. Oh, you want to borrow something? All right. Which one? You can only do up to $5 billion per issue, but within those boundaries, which actually $5 billion is not very much, but that's a different story.
The next thing he talks about is audit. So basically now regulators are not going to be independently validating completed findings. So like the MRAs, saying the regulators aren't going to go in and actually validate themselves. They will rely on the bank's audit function to do it if the regulator deems that the audit function is satisfactory. That's pretty big. Let's watch a clip.
Under this approach, if a bank had a satisfactorily rated internal audit function, that internal audit function would have the ability to decide if the bank had appropriately remediated a deficiency identified in a supervisory finding or enforcement action. A bank's internal audit function would essentially displace validation by Federal Reserve examiners. Examiners would not independently determine whether the terms of the supervisory findings or enforcement action provisions had been met, or whether the bank's changes were sustainable.
Here's what Miki wrote in that memo. She said examiners should not perform their own duplicative validations of whether a firm has fully remediated an MRA or MRIA or requirement in an enforcement action unless the firm's internal audit is rated unsatisfactory. Instead, they should rely on an institution's internal audit for validations when that function is rated satisfactory.
I mean, I guess back to my initial point about, the spirit of regulation, it's loosening right now. I would say that makes sense. Like, the counterpoint is that, that's, like, if I put on my Liz Warren hat, they're just all crooks and they're just instantly going to just do tons of terrible things. I think the reality is, a lot more subtle than that, just like everything. Like, working in one of these banks that has tens of thousands of employees, there are armies of people that, these audit functions employ. If they were just woefully insufficient, I don't think any institution could reasonably get by just being so obviously ridiculous. Even like within the industry, there would be rumors about how bad these people are. It would filter through to markets practices, just their business practices overall. If someone is just really obviously skirting the rules that they shouldn't and then telling regulators otherwise, that's kind of, at least what I would imagine Elizabeth Warren would say. I just don't see that being very realistic.
I'm a little torn on this one. I see both sides of it. In one sense, a good audit function, if you're rated satisfactory by by supervision, it sort of designates or shows that they have sufficient weight, that they're doing a good job, that they're challenging things. In general, in working at a bank, you can say that, yeah, audit can get you in trouble. And it's like part of their job. And what they try to do is do a good job and find things. It's not like everyone in the bank all loves each other and they're all like, oh, let's all, work together to try to fool the regulator or something. It's not how it works. There's people looking over the shoulder of other people. There are three lines of defense and they're all split and they all try to watch each other. And then they're not doing a good job. But then I obviously see that, it's probably better to have another set of eyes, a second set of eyes to come in and validate it. But here's what I think like the real kind of motivation for this one is. It's probably two-part. One is there's a huge timing problem with these MRAs. So like if on, say, January 1st, a bank has decided that it remediated an MRA. It's like, okay, we're ready to be checked. We think we've done it. Okay. But the thing is, the regulators often won't even go in to validate it unless audit has already looked at it. So like the regulators won't look at it by themselves. They'll have audit look at it first. And it's like, okay, fine. But audit operates usually on like a yearly schedule. It's not like they finish on day one and then audit comes in day two. They might come in months later or something to validate it. And then it takes audit a month or something to issue a report. And then only then would the supervisors schedule, right, the exam to validate that MRA. And like you schedule something, months in advance, they come and do the exam. And then even months after that, they actually issue the report and then it's finally closed. So like all in all, it could be a year between or more. Like it could be a really long time between an MRA was like done from the bank's perspective and when it's actually closed. And so like that's kind of messed up. This would like cut that timing potentially in half. Now the other thing I think, Miki's going after is just like, well, you just need like fewer, it's just less work for supervision, obviously. Right? The FRB is going to be doing less. So here's something that she wrote. Quote, when evaluating and rating bank holding companies, saving and loan holding companies, and the U.S. operation of foreign banks, the Gramm-Leach-Bliley Act of 1999 requires examiners to rely to the maximum extent possible on the examination and other supervisory work by the primary state or federal banking supervisor for their depository institutions on subsidiaries other than the state member banks. Federal Reserve supervisory staff should not conduct their own examination of such depository institution subsidiaries unless it is impossible for the Federal Reserve to rely on the examination of such a depository institution's primary state or federal supervisor. Impossible, Joe. I mean, have you ever seen the word impossible in any memo at the federal, like internally?
Never.
That like your eyebrows go up, I got to say, if you've been in this for a little bit, the impossibility standard. Okay. Nuke dropped. She elaborates a little bit on it afterwards. She did kind of, address what that could possibly mean, like what is impossible.
Unless it's maybe probably not possible in a way that would be practical at this point in time. That's usually what I'm used to.
And, Miki's brave. Miki, usually when I've seen, and we talked about this before, we've complained about this, how executives are kind of constantly trying to expand and otherwise, head outward in their domains, get more budget and stuff like that. But Miki's straight up saying like, we're going to be stepping back. We're going to be relying on the OCC, FDIC, state regulators more. We're going to rely on the audit at the banks more, and we're going to shrink. So I think like supervisory numbers, the number of supervisors at the Fed is going to decline. And this was like the third point that Barr mentioned in his speech.
She was chosen by Trump in his first term, and deregulation has always been the big theme. She's clearly a big proponent of that. I don't think there's anything inherently wrong with scaling back regulation. Like, again, if, my view is that these things do oscillate. I think they can be a little too heavy-handed right now. And if the financial system starts to crumble overnight, then just hire these people back. And I highly doubt there's going to be mass layoffs or something like that. They'll probably
if the financial system starts to crumble, just hire them back. Is that what you said? It's too late, man. Blood's on your hand if that happens.
Yeah, but then the next person's going to come back and fix it.
Right.
And then the cycle starts over again.
You really think that, though? You're saying that, like,
that's what
it's going to lead to, like, it's a little dangerous here too, because at some point the financial system's going to tank, and you can point to this moment, unless it happens like a decade or something after this moment. You could probably call that's sort of like the runway that you could probably still blame, like this kind of deregulatory stuff. No,
I mean, because financial crisis, like they come in all different kinds of shapes and sizes. 2008 was obviously due to the U.S. financial system. COVID had nothing to do with the U.S. financial system. You look at the late 90s, that was a huge financial crisis that was due to Russia and East Asia. That really had nothing to do with the U.S. system, but that impacted U.S. banks quite substantially. I don't think anyone would argue any of that is a function of regulation in the way that 08
yeah,
was.
Right. So not necessarily is the answer. I think that's true. And the other thing here is, like, this is mostly, even though these do sound pretty dramatic, this is mostly a pruning. I don't think people really appreciate how many and new like regulations that were put into place. Like Reg YY is a big one that talks about this. They're not going in there saying get rid of Reg YY. Okay, there's pruning.
Mickey's
there's
not saying we're closing the doors here. It's like I briefly made a comment. It's like I doubt there's going to be mass layoffs. They're probably just going to have stop hiring people and let people naturally leave, retire, whatever. Just start scaling down the functions very gradually.
So this is already a pretty long episode, but let me try to rattle off some of the other just ways in general that in the industry deregulation is happening. But first, can't quite leave that Miki Memo. She wrote that quote, examiners and other supervisory staff will no longer be permitted to communicate MRAs and MRIAs in vague or overbroad language. Instead, they will be required to communicate MRAs and MRIAs with sufficient specificity so that a person of ordinary intelligence can readily know what the deficiency is underlying an MRA or MRIA and what a non-deficient state would be. Sorry, that's kind of funny to me. I mean, I've seen this before. They can be tough to write. And like, here's the dilemma. Regulators need to acknowledge they don't actually like run the bank, right? Bank management does. So they might write, something like, we found this problem and you should make it so that this was not a problem anymore. And then they'll be like, oh, well, how exactly are we supposed to do that? And then the regulator might say, well, it's your bank, but you decide.
Yeah.
Which is kind of frustrating. Another one from the Miki Memo. So they should not delay the termination of MRA, MRIA requirement in enforcement action if the underlying deficiency has been fully remediated in order to test over a period of time whether the remediation is sustainable. So that's a big one. And that word sustainable was also used by Barr. I think we caught it at the end of that last clip.
Had been met, or whether the bank's changes were sustainable.
That's kind of another big deal, because oftentimes, remember how I said before this can take a long time? Sometimes even when the regulator shows up and they look at this and they realize, oh, it's only been in place for 1 quarter. Why don't we make sure it's working properly? We'll give it a few quarters and come back, and then we'll close it. That's what they mean by sustainable. And that's also, I guess they're saying that's kind of BS. So Mickey is definitely saying, like, no, we're getting rid of that practice. Some other things that were not mentioned in the speech, but that I would lump under the deregulatory swing. A big one, trying to relax the supplementary leverage ratio and the community leverage ratio. That's just straight up, changing what the numbers you need to hit. Eliminating horizontal reviews, unless Bowman, I think, deem that they're necessary. Horizontal reviews is like, it's just like a standardized exam. They just give kind of the whole industry just to kind of collect data on what the state of the industry is. There was a final rule adjusting the indexing certain regulatory thresholds from the FDIC. That's sort of an interesting one. So I mentioned before, there are certain thresholds, like certain asset sizes, for instance, how big a bank is before they're considered like category 1, 2, 3, 4, or whatever. And, category 3 will have like 250 billion or more in assets. But those numbers were set sometimes in the past. And Joe, 250 billion just isn't the same as it used to be. Just not quite the same. So there's some talk about kind of indexing that. You stick it with inflation or something and say, okay, the line is no longer 250. It's, 250 plus whatever the inflation would be. So maybe it's like 300 something billion. And it's that line that you hold them to. So like, that's the proposal. That's another pretty big one. But yeah, man, that's sort of what a regulatory pendulum swing looks like.
Yeah. I would definitely
supportive,
agree.
Broadly supportive.
Yeah, I mean, I think I've just been kind of peppering some of my thoughts in throughout this here, and yeah, I'm definitely supportive. I think these are all really reasonable things to do. I think people have a tendency to kind of over dramatize things sometimes. There's just going to be slightly different rules along the way, and things will drift a little bit, and I think that's kind of the natural order. I think it's just generally back to a smaller government mindset in general. It's good to pare things back every now and again.
Yeah, prune. I think the word kind of is you're pruning a little
exactly.
bit. I mean, the tree of regulation is still very much there, or the shrub or something. I think
we're just cutting off a couple dead leaves.
In perspective, they're not saying let's go back. Let's not throw out Frank Dodd. Okay, let's not throw out Reg YY, Reg RR, Reg O, Reg. I mean, all these things that came about. They're not. These proposals are not to say let's get rid of those. They're just a couple places where they're like, let's kind of ease off here and there. Barr, I think, made some good points. But in general, I think he's on the wrong side of this.
Yeah. I mean, I think that's a big reason why reading through, hearing these snippets from Miki's memo, from a central banker's perspective, it is, it was pretty drastic, pretty explosive. But in actuality, I don't think it's going to be anything, certainly not anything revolutionary. We're just shifting the existing framework a little bit. I'm clearly biased here now. I didn't really like Barr that much. He was very much like the world's going to end if we don't do these things. Like, no, it's not. Like the world is not that fragile. Everyone is trying to do a good job. There are and always will be bad actors here and there, but by and large, that's kind of how the system works. There's still a lot of guardrails around it. It's not like saying you do whatever you want now.
Maybe. I mean, it's always healthy to have somebody, argue the other side and all that. And there's even, besides this, there's a lot of stuff we did not cover that go even into like more depth, super technical stuff, like P factors and stuff that I had to like read about. Yeah, that's all I had for you today, Joe. Thanks everyone for listening to another episode of the Root of All Evil podcast. I'm Luke.
I'm Joe.
And we will hopefully see you next week. All right.
See you then.
Take care.
Bye.
Bye.